Me.
No.
Yeah, no, it's not the one I meant to lead. It was, like I loved working in Asia. It was all of my dreams come true when I was moving to Singapore. I'd worked in Japan before, I'd worked in Hong Kong, I'd worked in Indonesia. So I'd really succeeded during the early part of that, but then, made some really, really bad decisions. And unfortunately, they weren't, and I don't blame the controls, I accept full accountability and responsibility for everything that happened to me during that period. But if there had been more, from the organization's perspective, if the controls had been better, if they'd been more robust, I would have been going to jail at some point, but the organization would have survived. But the combination of two led to the collapse effectively.
Yeah. Eric, maybe I'll start with you. When I listen to Nick, and not to put words in your mouth, Nick, but I get the sense a little bit that you got in a little bit of trouble and then thought you could kind of get yourself out of trouble if you just could, couple of things could go your way, and the hole kept kind of getting deeper and deeper. And maybe you promised to yourself at night, if I could just get myself whole, then I promise never again, kind of thing. I mean, was that a little bit going through your head, Nick? And
to a certain extent, I mean, you hate what's happening to you, so you're getting deeper and deeper into it. So the first time I put a trade into the illegal 5/8 account was because I'd seen so many people do it before me. Mm-hmm. Barings was an organization where trades would be warehoused overnight. You might have to, the price that you traded at might have been wrong for the client. So when I worked in London and in Tokyo, you would regularly see salespeople, traders, put trades into error accounts and warehouse them for a day or two. So for me, it wasn't the big step that it should have been when it was my turn. So it was far too easy to do because I'd seen it before. But then you're right. I'm genuinely trying to get out of this trade every minute of every single day, and then it's just growing and growing and growing, and you get to September 1992, which was the year end, and it's $5 million. Right, and the auditors are coming in. This is a hurdle you're not going to be able to overcome, and you just very last minute. I phone up the Treasury Department. I ask them for $5 million, and they wire it out to me the next day. So I passed a journal on the 30th of September. The money arrived on the 1st of October. So when Deloitte's were doing the year-end audit, there was a discrepancy of $5 million. And they put it down to a foreign exchange discrepancy. Mm-hmm. And that's how I survived the first audit. Without me even knowing, that was the rationale that was put behind it.
So Eric, maybe you can, there's nobody in this audience that doesn't know about what happened at FTX, but maybe you could frame it for us a little bit, and then as a follow-up question, maybe I'll ask you that question. Do you think, and then maybe Nick, I'll get your reaction to it, do you think, there's kind of two, if you listen to the podcasts, the numerous podcasts on this, there's sort of two schools of thought. One is that this was just never worked from the beginning. It was always just fraud from the beginning, or there's a second school of thought that was like things were going well and markets turned, and especially sort of the spring and Terra Luna, and then, he's just trying to kind of get out of it. So can you kind of just frame a little bit what happened and then give your view of what you think happened based on your 25 years at JP Morgan?
So what I think, well, I guess Nick stole my line. It all began in 1992 when a young man called Sam was born. I don't actually think that's, from my perspective, I almost maybe taking a step back from FTX. It's 100% the case in every situation I've seen. If there's an ability for somebody to put their hand in the cookie jar, eventually somebody somewhere is going to do that. And if you have an industry where you can have an exchange, a custodian, and a hedge fund all in the same situation, all unregulated, and when I say unregulated, I mean unregulated in the most broad terms. So if you could have a construct where it's regulated by code or by smart contract, then I put that in the box of regulated. But if you have a situation where somebody, without anybody else knowing, can raise a bunch of money from clients and then use that money, they're going to do it. Now, my personal opinion is, if we look at bank collapses, they often say that they happen slowly and then they happen quickly, right? And that's when you have asset quality and everything's happening in a clean way, but they've done some bad lending or something. That's typical with fraud. It just happens quickly. And in the case of FTX, it was beginning of November. We have the CoinDesk report showing the balance sheet of Alameda, and hardly more than a week later, it's in bankruptcy. So my personal feeling is that it was probably a lot like Nick's situation, where they had been trying to be relatively clean, and if they weren't trying to be clean, I don't know why they would have gone through the effort to try and sort of go through the motions on the regulatory side of things. And then whether it was Terra Luna or something else, I think it ended up with a hole in the Alameda balance sheet, and then it ended up with the one day when you realize you've got a hole to fill and you kind of know you shouldn't do it, but you take some money from client funds and you use it to fill the hole, and then it just spiraled from there. That's we'll find out soon enough, I presume, but that's my best guess.
Yeah, I mean, that's the part I don't get, though, because why wouldn't you just let Alameda go and preserve FTX? Why would you put both at risk?
Because to Nick's point, you think you can fix it, right? You think a couple more good trades, a couple more good days, a couple more, maybe you can go out and do another round. You've just had a round earlier in the year that values your company at $32 billion. And remember, when people look at it, which is incorrect, and they go, oh, this was a $32 billion plus client funds financial loss. It kind of wasn't, because if you look at all the money they raised, maybe it was $2 billion, but it was valued at 32. But that 30 billion of the 32 was kind of phantom money because it wasn't ever value, right? It wasn't there. But I think you get to a point where you're trying to protect that. You feel like you're the fastest person in the world to be a multi-10 billionaire kind of person, and if you can just kind of fill a hole that's maybe a few $100 million, which you feel like you can probably do, then everything will be okay. And I can absolutely see the psychology of that, and certainly it's happened many times before.
And Coy, you worked for Hester Pierce, which is, I would say she's probably the crypto ecosystem's favorite SEC commissioner. She does get it, for sure. Did you meet Sam Bankman-Fried, first of all? Did he? Because he has this regulatory. And what was that like?
Yeah.
Was he a schlub, first of all, or did he dress up to come into?
No, I think like most folks he met in Washington, he had a persona that he met and dressed as a coder, and everyone saw him testify before Congress with his shoes with no shoelaces and wild hair and everything. And I think that fits into something, Nick, you were saying of, people want to believe what they want to believe. And here there was this image that was being cultivated of this whiz kid, of this MIT grad who is the savior of the crypto industry and the like. So it was, reflecting on it, definitely an interesting experience and a reminder to be critical of things that may look too good to be true, or folks that may be presenting themselves differently than who they are.
Mm-hmm. And did he do kind of what Nick was talking about? He was very confident, and you might not, you guys don't get it maybe, and this is what I want to do, or was he, does he?
Yeah, I'm not sure that he was. I think his thing was a little more quiet and reserved. Mm-hmm. Of he's the coder. He wasn't super aggressive in the conversation I had with him.
Okay, and so what pieces exactly of the regulatory environment would have kind of saved this for investors? Like what was missing exactly? And then I have a follow-up question for you, but let me ask you that first.
Yeah, I think it's first important to remember that regulation is not a magic cure-all, right? Everything we just talked about, you worked in a highly regulated industry and bad things still happened. With that being said, you can still put, basic restrictions and limitations in place, and I think the U.S. securities regulatory framework is a good example of that. It's certainly not a model of efficiency, but it serves basic core purposes quite well. So, when you're buying stocks in the U.S., you don't go to NASDAQ or the New York Stock Exchange and open up an account and have one entity control the entire investor experience, right? You have a series of intermediaries. You go to a brokerage firm, you open up an account. The brokerage firm will transact with any number of intermediaries, and that's somewhat by happenstance, but also somewhat by design, right? And each level of intermediary addresses different concerns. They address conflicts of interest. They address protection of customer funds. They address risk management policies. Public companies, have to disclose audited financial statements. They have corporate governance requirements of actually having a board of directors, having certain experts on a board of directors. I think all of these things would have, in hindsight, certainly benefited the FTX situation.
The board. Maybe can I add one thing in there,
No,
Staci?
yeah, of course.
I mean, just to give one example of this. So, when I was working in a banking environment, the bank also owns, you've got a bank, which is where the customer deposits are, customer fund, just depositors' money, if you want to think about it that way. You've got a holding company above it, and you've got a completely separate asset management business as a separate legal entity. This is a fairly typical setup. Now, if I'm sitting in the bank and I want to do a trade with the asset management business, which is just people on the street kind of giving their money to be invested, that would be, because of Reg W, much more difficult for me to transact with my in-house asset manager than it would be for me to transact with some complete third-party asset manager. And if you think about it, the reason for that is because if that protection is not there, then you can be inside the investment bank and you can be selling all your dud securities that you don't want into the asset manager, and then they blow up, which is a conflict of interest, and you can, put all your dud loans in there and so on. And so I think those kinds of separations that you were talking about, they're quite, they're quite important. And obviously that can be enforced by a regulation, by code, by transparency, by whatever. But, I think that's a important point.
But, I mean, reconciliations as well. I mean, just simple reconciliations.
That's what I was going to ask you. What are the most important things on your sort of to-do?
Look, just position reconciliations. And unfortunately, I don't know a great deal about the crypto space, and I freely admitted that, but I was listening to the CEO of Binance the other day on CNBC or something.
Hot topic.
Yeah, and he was talking about, how you can use the code or the hashes to reconcile that your position is actually held at the exchange. I don't know if that's a thing or not. He said they hadn't been doing it at Binance for the last 10 days, but they were going to start to do it again. Reconciliations have to be done every single day.
No, I think it was reconciled in that 8 billion mislabeled account that he had.
Yeah.
But we're jumping all around here, but so you were talking about during your audit, right?
Yeah.
You have the audit. The money's kind of not there because you've got it in a fake account or something and then you get 5 million sent from London to cover the hole, and then you kind of send the money back, right?
Oh no, I never sent.
Oh, you never sent it back.
No,
you kept it.
effectively,
Okay.
what I was doing through the 2.5-year period was I was swapping a P&L item, the loss in the 5/8 account, for a balance sheet item, which was the margin that was being posted to the exchange. But they never interrogated the balance sheet enough to ask the question, okay, we've got 650 million with the exchange, but we've got these tiny positions. It doesn't add up. So you've got to investigate and interrogate the balance sheet in order to ask that question. It was just the only reconciliation that they looked at in Singapore at the time was whether the account balance line agreed. So as long as my 5/8 account balance was 0, it had no impact on the account balance line, and all I was doing every single month was selling another round of options to bring the account balance line down to 0, and nobody looked any further. But the margin at the exchange was just growing and growing and growing until it reached 3 times the capital base of the bank. Absurd levels. 10 times the legal limit that you could lend to a subsidiary, and the Bank of England allowed that to happen. So, the breakdown is everywhere.
Soup to nuts, yeah.
I mean, FTX, did they have audits? I mean, what were the auditors doing? Do they have audits in these companies? I'm sure they do.
I think that
You're sure?
No, well, no, I'm not sure. No, we had audits. They just weren't particularly. I'm sure they have audits. They just might not be particularly good. I don't know.
I mean, this happens in market froth always a little bit, but I just think, there was, you've got 48 hours or 24 hours, you're in or you're not in, the money. And then if, just say Sequoia's in, well, Sequoia surely did the due diligence, right? We were just kind of, free ride on the back of Sequoia. And then, you look around and nobody's asked for a board seat. Nobody's done the due diligence of the money. This is what my suspicion of, at least in the VC space, But Coy, let me circle back to something that you said, because, the whole point of crypto, there's a number of points to crypto, obviously, but the whole point is that you disintermediate all of these intermediaries that are just completely ridiculous most of the time for trying to do some very simple things in a much more efficient way and a much less cost environment. So the answer, if you believe in the preservation of the state, this state, and let's just stipulate that we do, because you are speaking at a crypto conference after all. What regulatory environment can you imagine that could solve for something like this without throwing the baby out with the bathwater, right? Like what's a reasonable regulatory environment that could catch the SBFs in the net, but let all of the kind of the good stuff through?
No, and I think at the end of the day, a lot of the U.S. in particular is struggling with what is the right regulatory framework, and it's really not rocket science. I think as a first principle, just leveraging the technology itself to achieve the public policy goals that you're trying to achieve as a regulator. So if transparency is a concern, one way of looking at it is we need auditors to come in and look at the financial statements and do everything we've done traditionally. Another way of looking at it is let's do a smart code audit. If everything's on chain, let's make sure that this information is out there and that people have the knowledge to be able to assess what's going on. From there, if you're trying to get more specific, I think there's some clear steps you can take preserving the utility and the promise of crypto. Clear guidance on what in fact are these crypto assets. I think the definitional step is the most important step in creating any regulatory scheme. So in the US, you have the big debate of, are tokens a security? Are they a commodity? Answer that, and the rest will flow from there. You can address what type of disclosures should be provided, who provides those disclosures. Regulators are used to having a central entity to grab hold of. It doesn't have to be a central entity. If there's a group of people that are willing to provide data, willing to provide information, there's no reason why that information can't be provided that way. And then you can start tacking on the trading of the crypto assets, start addressing the concerns that we're seeing in the FTX debacle of just some clear basic rules of the road of, there are going to be centralized entities in the crypto space. So if you are a centralized entity in the crypto space, you're going to need some rules to comply with. And I think providing those broad strokes would go a long way.
And I guess the other thing is too, is everybody's focused on them just stealing client assets, which to me seems like really simple. I mean, whether it's, if the client asset is a pile of coal, is it a commodity, or it's a bunch of money somewhere, or it's just stealing something that you said you wouldn't touch and it belongs to the client. Like that's one point. And then the other thing, which it's kind of out there, but I'm sure, as Warren Buffett loves to say, cockroaches never travel in ones. And so if you see one big problem, there's going to be a bunch of others. And I think the theft thing is kind of obvious. The fact that the hand was put in the cookie jar and the client assets were grabbed to fill whatever he wanted to fill with them. But there's also just general kind of front running, right? I mean, there's the reports about the liquidation protocols that were being used, favored Alameda.
Yeah.
There's going to be a bunch of other problems, I'm sure, coming out as well. And so I guess part of the problem here in my mind is an exchange doesn't need to be anything more than just a matching engine. All you're doing is, back in the day, people used to meet under a tree somewhere, and they had assets to sell and assets to buy, and everybody knew that that's the tree that you go to if you want to transact. And maybe you kind of take your satchel full of stocks and shares or whatever it is, and you go there and you do your business. But that's the central function of an exchange. The central function needn't be kind of holding on to your stuff for months and months on end. And so I think, to my mind, that's where really the focus should be in the future.
Yeah, I mean, to put a finer point on it, we don't need new rules to say don't commit fraud, right? I mean, stealing customer assets is already illegal. We don't need a whole framework around that. It's providing sensible restrictions in place, and I think, DeFi is a really interesting example of how this technology can be leveraged in a way that allows people to minimize the risks that we see in these centralized entities of potential fraud and everything. And maybe that's a path forward. DeFi protocols have held up a lot better than a lot of the centralized trading in recent months.
Yeah, over collateralization and smart contract, and you don't have to trust anybody. I mean, it's the point, right? But Coy, one of the criticisms levied is that in the U.S. regulatory environment was so unclear, and that is what's forcing sort of FTX offshore, and we're kind of the best is the enemy of the good, right? And sort of regulation by enforcement, sort of guidance, and what would you do if you were sort of in charge and to
Yeah.
How do you, what do you think of that, and then what would you do?
Yeah, I mean, I think it's totally fair criticism. The SEC has really messed things up in the U.S. and has, in fact, driven folks offshore. I'll caveat, look, the people that are responsible for stealing customer funds are responsible for stealing customer funds. The SEC's lack of sensible actions doesn't absolve them of their responsibility, obviously. But the SEC has not created a framework within which folks can grow their businesses in the U.S. I think it's, maybe I can paint a picture of an alternative universe. When I worked at the SEC, I worked for Commissioner Peirce. She proposed a safe harbor proposal that would have allowed token issuers to get their projects up off the ground. There would have been tailored disclosures. It would have been almost a securities disclosure light regime. And at the time, the idea would be to exempt any secondary trading of tokens, but it would have, if the SEC had acted on that or something like that, you would have an entire universe of crypto projects that had some type of touch with the SEC. That information could have flowed through the commission, experiences could have been had to learn lessons about what type of regulations, if any, are needed on the crypto trading side. The SEC, the CFTC, all these agencies, they could go ahead and implement rules through the normal notice and comment process. That allows everybody to have a say on why a proposal is a good thing, why it is a bad thing, why a certain existing rule doesn't work. But instead, we have seen an enforcement-heavy approach, and Chair Gensler has been enforcement first and really strong rhetoric saying every crypto asset is a security, come in and talk to us. But then if you come in and talk and ask for registration, there's no path forward. So, it is an irresponsible act by the U.S. regulators to not provide a workable path. If you're going to exert jurisdiction over a space, you need to have a clear path forward to do so.
Jesse Powell, the founder of Kraken, sort of famously tweeted a couple of weeks ago, red flags, and I'll just read you his red flags. Acting like you know everything after showing up to the battle 8 years late, bit of a dig, 9 figures buying political favor, being overeager to please DC, huge ego purchases like 9-figure sports deals, being a media darling, seeking out puff pieces, effective altruism, virtue signaling, and FTT. So this is very obviously from a crypto sort of point of view. But let's talk about red flags. And what, as an investor, or a regulator even, what do you think about, how do you think of red flags? And maybe Nick, I'll start with you again. What would you look for in this kind of?
It's very difficult for me to comment on the crypto space.
Yeah, in general, I guess.
Yeah, I think one of the things I don't understand, and perhaps you can explain this one to me. If a traditional exchange is owned by the members, whereas this exchange is owned by effectively one individual. And so it's not an exchange in the traditional sense.
No.
Is that true?
Correct, yeah.
Yeah, and just those sort of things, and how that can happen, and how it can be, how it can be centralised under one particular person is strange for me. Just coming from that more traditional stock broking.
He's got it as a side sleeve for a hedge fund.
Say that again.
It's kind of like a side sleeve for the hedge
Yeah.
fund as well.
Exchanges
So-
owned by their members are kind of going out of favor anyway, though.
I got 2 to put on the list.
All right.
If your buddy Sam Trabaco from Alameda, who you grew up and built this thing up with, leaves, and then Brett, who's running FTX US, leaves in very short succession, that's kind of a red flag.
Okay.
Yeah. If you have very young people saying that, there's sort of personal family situations, and maybe I'd like to spend time on a boat and stuff like that, it's normally a bit odd when that,
Such a successful rocket ship, too, right?
yeah, it's not definitive, but it's suspicious.
Yeah. You had 2? I thought, Eric,
Yeah, I think,
did you have 2? Oh, no, sorry.
There was 2 individuals,
Oh,
so
2
those were my 2.
Okay, Coy.
yeah, I mean, maybe the other flag to add to the mix here is, when the entire industry is in a downswing, if there's one person raising their hand indicating that they are outperforming wildly everybody else, I think that's certainly something that should raise eyebrows.
Yeah, market share, I think, is the other one as well. I was probably 50% of the open interest on the Singapore International Monetary Exchange. I was definitely half of every trade that was going on in the Nikkei 225 pit, and it just defied belief. So much so, and this is a slightly funny story, that in 1994, the Singapore International Monetary Exchange had a big award ceremony, and they invited the management of Barings to come from London, from New York, and from Tokyo to receive the award for the highest customer volume on Cymex. That volume was my illegal 5/8 account. But they came and they accepted the award. But that's how bizarre it became.
Did they wonder why there was no customers there?
Yeah.
It was only you to welcome them.
Yeah. Well, my wife was there. That was,
Right.
she was the customer. But I'm sure there's going to be episodes. I'm sure there's going to be episodes that come out of FTX that are going to be similar to that. Everything that I look back at during that particular time is completely nonsensical. Futures and options are cash-rich businesses. You receive more margin from your client than you pay to the exchange. Yet I needed £650 million to keep the business going. It's complete and utter rubbish, and it should have been picked up at the very first hurdle, and it didn't. And the episodes of Barings had a big party in Grand Central Station in New York at the end of 1994 to celebrate all of the money that we were making in the debt products division. Yeah, and they flew everybody there, 500-600 people to celebrate. And still, I still couldn't enunciate what was happening. I knew it was a tissue of lies, but everybody's buying into the success story around you. And it doesn't propel you on, but you have all of these status relationships that are building, and I didn't go as far as support one of the political parties in the US, but because I didn't have cash at my disposal, mine was very much trying to survive for another day type of thing. But those status relationships, and that everybody believed that every time they traded with me, they lost money, whereas the opposite was true. But because I was manipulating the exchanges in 2 locations, it did look like that for a period of time. But yeah, those status relationships, it's very difficult to let them go. I think age is another big factor. I was 25, he was 25. You look at Jerome Kerviel, Kwaku Adebole, those rogue trading episodes as well. Very young people, not mature from a business perspective. And, I'm a lot older than everybody in the room, but you have an industry that's, the average age is quite young. And, you know, and I'm sure that these people are all in a far better place than I was all of those years ago. But there is going to be an element of immaturity in certain parts, and you have to be a little bit careful of that. I wrote a book on stress with a psychologist, and he talks about status, I talk about success. But he ends the chapter with the phrase, when an immature person has status, they will do anything, absolutely anything, to protect it. And that kind of embodies a lot of what happened to me during that period, because I was, you know, the exalted individual who everybody thought was, you know, turning water into wine or whatever the phrase is.
I mean, I don't know him, but that does ring a little true to me about SBF, right? He was, you know, the golden child, and I'm sure he enjoyed being the smartest guy in the room, and you know, having these policy conversations and doing the bailout. And it's very hard to imagine, you know, maybe not being that guy once you're that
the
guy.
magazines.
Right.
There's a lot of, I'm sorry.
No, go. I was just going to say we will have some time for questions at the end. So think about a question if you want to ask one. But go ahead.
I was just saying, there's a lot of power in being able to, you know, have lawmakers pick up the phone when you call,
Right,
and that's a position you don't want to give up.
Yeah, right, exactly. Okay, so maybe this is not a very nice question to ask, but I'm going to ask it anyway, and you can ignore it if you want to. Given the red flags that we talked about and the whole thing, when you scan the horizon, do you see any red flags out there? I mean, as I said, you don't have to answer, but I mean, if we have the sort of the framework for thinking about this, might you apply some of the red flags in your head, or just things that you know, make you, how would you?
Yeah, because I mean, I don't need to name any names, but I look at it sort of economics, and the world will evolve in a certain way in accordance with those things. And by those things, what I mean is that if you have an environment where people can break rules, then they will, right? It doesn't mean that everybody's a rule breaker, but I guess that's, you know, there will be somebody in that circumstance who will break the rules to their own advantage. More importantly than that, I would think about it like cost of capital. You know, you often say, okay, let's imagine that you have two identical companies, and one of them has a cheaper cost of capital than the other one. Well, the one with the cheaper cost of capital wins because they grow faster, because they can get more investment, they can pump it into the business, they can do more things. And so if you have something where people can use client funds for other things, right? They can effectively treat clients' money as just capital for growing their business. Somebody's going to do that, and the people who do that are going to grow the fastest, on average. So it's kind of like a biological law of the jungle, evolutionary principle, and I think if...
Who do you mean, Eric?
Well, no, but I just think, you know, Binance and Tether are the obvious ones, right? I mean, Tether's been preventing, fine, I will say it, but I mean, like, we've talked about this for ages, but I mean, they've just been presenting red flags left, right, and center forever, and they 100% have the ability to remove those red flags if they wanted to, but they don't, so why don't they? So it just seems to me that's like an obvious one.
Coy
Yeah,
at
so
Steptoe.
I'll jump in there.
Tether's a client of Steptoe.
We've represented Tether for quite some time, and there's just nothing to the allegations about lack of reserves or anything like that. And I think that's been shown by the investigations from New York, the state of New York, and the CFTC as well. But I think, you know, looking bigger picture, skepticism is good. People, you should be careful where you put your money and conduct due diligence, and I think that's really important. At some point, I think it crosses the line into just pure rumors and everything, and so I think as the crypto community, as a larger community, probably needs to take a step back. If you've been on crypto Twitter for the last 3-4 weeks, ever since the FTX collapse, it's just it's a circular firing squad. Everybody is pointing the finger, trying to guess who's the next domino to fall, and that's not really a healthy place to be in. I think, again, skepticism is good of where you're putting your money, but just kind of trying to point the next domino to fall is kind of a dangerous game, I think.
Okay, so let me say this. I would say if I go and buy think about something that's asset-backed, probably the simplest thing that looks like a stable coin that's, if I was to pick an analogy, I'd pick a run-of-the-mill, really normal, standard money market fund, and maybe I can go buy one from PIMCO or BlackRock or somebody like that. So when I look at that money market fund and the prospectus and the reports that come out monthly, I'm going to see line by line in there with the ISIN number, every single thing that's in that portfolio that's backing my investment. And there's going to be a regulator who's going to kick the shit out of them if any one of those line items is incorrect, right? And so I guess I do think that within this industry, if we're going to mature and we're going to progress, it's helpful for people to point out when they see things that can be corrected. And if those things are not corrected, maybe it's just because the advice is not being heeded for whatever reason, or maybe it's actually that there's something deeper, right? So that's kind of the way that I look at things. But I do think that these sort of, criticism, FUD, whatever, it's, crypto Twitter and so on, there's a lot of people kind of respond and go, FUD, yeah, it hasn't blown up, it's been 8 years, everybody said it, la 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 la. If we're going to mature, then all of these things like proof of reserves and transparency and using smart contracts, these things we're going to have to start using these, right? Because if we keep going on with blow-ups and retail people losing their money and scandals and fraud, the regulators are just going to come in and shut the whole thing down, right? So that's why I do think it's important that we speak up on these things.
Okay, can I moderate a panel or what, ladies and gentlemen? Okay, so Coy, did you have something that you wanted to say? On
Yeah,
that,
I mean, the only, maybe touching on something you mentioned earlier, Eric, I mean, regulation can come in many different ways, and I think transparency amongst stablecoins as an asset class is something that private ordering is really starting to do a lot, and a good example of where you may not even need a proper regulator to come in. That's obviously one model, but certainly progress can be made based on market pressures, which I think is the point you're trying to make.
Yeah, it'd be great if it happens based on market pressures, and I think it'd be terrible if sort of the trust of investors keeps being abused time and time and time and time and time again, to the point where ordinary people lose money and politicians feel like they have no other choice but to come in and stamp on it. And having been very, very close to the financial crisis and CDOs and CDO squareds and derivatives and all this kind of stuff, I'm definitely very much of the view that the more egregious people think the behavior is on the political side, the more they're just going to be completely unreasonable and just come stamp on it. So I think to kind of get the benefit of the trust, you have to earn it.
Okay, let me take some questions from the audience. Please stand up, and I see 2 hands, and I'll take both at the same time. And just a friendly reminder that a question has a question mark at the end of it. Sir.
Thank you. So my question is for Nick. I want to ask if you could generalize from your experience, is prison restorative to the rogue trader?
Okay, and a question over here. Grab the mic from, sorry, you have to give up the mic when you, yeah, there you go.
I'm Wragge from Unity, and my question is to all of you. I know it's very popular and easy to point finger, and rightly so, at the SBF, at Adam Neumann before. Where are all the Silicon Valley investors? What happened to due diligence? What happened to fundamentals? What happened to involvement in the decision-making process with kids that are not even 30 years old? Aren't we too fast pointing fingers and are not really looking at how this process is being actually operated for years? the hyper expansion is why a lot of these things are happening. What do you think about it?
Okay, just because there's 5 minutes left, let me see if there's one or two more, and we'll collect them all together just to make sure we have enough time. Okay, so I've got one up front and then one in the back. Okay, go in the back first, Jay.
Yeah. When you answered the question about red flags, you answered it from the context of like another FTX, another exchange, something like that. What are red flags more general in crypto? When we think about speculative industries that were spending capital, like Amazon and Uber, you could still take a ride, you could still get a textbook delivered. What are the non-speculative things that are success stories? I feel like that is a better place to look for potential red flags. So my question is, what are the successes and what are the red flags outside of exchanges?
Okay, and the last question here, and I'll repeat for you guys.
Hello, Eugene, Helion Ventures. And the question is about two biggest cases of this year with Luna and FTX. So from your point of view, how do you think, is it more a mistake or a fraud? And if it's a fraud, who could be the next FTX? Thank you.
Okay, so kind of difficult questions all around, but how do you think about red flags in a non-exchange environment? When you think about sort of from the summer on, how do you feel about, like, is it stupidity or evilness, fraud, or is there just some kind of laxness going on? And then a question about just, come on, isn't it up to investors to do some due diligence themselves, and where does that lie? And then, Nick, if you choose to, but you absolutely don't have to, answer a personal question about your life. So why don't we go down the line? Who wants to start?
What do you?
Yeah, I'm happy to start.
Okay.
All right, so
Okay.
let's start with the red flags outside of the exchange process. I mean, one obvious one, I think you hit on it. If you read a white paper or you're on a message board and you're trying to understand what a platform does or what a project does, and you can't, like, if someone's telling you, oh, you don't get it, you're not smart enough, you don't have the background, there might be something there. That's a red flag. You should be able to understand what the project is all about. I think that's just kind of basic, right? I think moving on to the question about due diligence by venture capital and investors more at large, I mean, I think you're right. This, there's FTX is to blame, or Sam and whatever individuals that are responsible for these specific acts are to blame for those acts. But this is exposing a lot of shortcomings within the larger ecosystem. And if money is flowing around so freely that firms feel comfortable making large investments without getting board representation, without really opening the books, and I think that does expose some weaknesses in that system, and I think that's something that's being heard. You're seeing movement to kind of double down on some due diligence requirements there.
It's harder in a frothy market, though. It is. It's because you miss out, right? And then the guy down the street will grab the deal, and it's hard to.
I think there was, there was the question about Terra Luna, I think, and also about maybe the VCs I'd touch on for a second.
Yeah, you don't have to answer all of them. Pick the ones you like.
Yeah, so well, I do like these ones. In my mind, there's a very, very, very big difference between Terra Luna and FTX. So Terra Luna blows up, stablecoin goes to zero, et cetera, et cetera. To my mind, the way in which it blew up was entirely predictable, right? Because the price of the stablecoin relied on a variable token kind of having some value so that you could sell enough of it to keep the price propped up and so on. And so I think, like, if you could, that information was there, it was available, and you could either take that risk or not. And if you took the risk, for a while it was good, and you get paid your 20% through Anchor and so on, and it's all wonderful. Like, but to me, it's not necessarily okay, but it's in a completely different category than giving your money to an exchange, and the exchange says, don't worry, we're not going to touch the assets, and we're just a matching service, blah, 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 and it turns out they've got like a $6 billion hole in the balance sheet. Those are two completely different things. One, you can kind of understand and take a decision. One, you can't, which I think is related to the VC point as well. So people look at it, and to be honest, this happens in investing a lot, right? Where something blows up, people lose a ton of money, and then they go, how you're so stupid, like, why did you do that thing, and so on. And all I would say is, like, particularly at that time, crypto is a hot market. The people who invested in the Series A, B beforehand, mark to market on paper, they've made a ton of money, right? Oh my God, it's up to 32 billion, and it used to be worth like $1 billion a year ago, and it's so hot, we got to get in, whatever. Yeah, Sam's obviously playing the game. He's going on Twitter. All these VC people are assholes. Like, I don't know, no. He's making it a very competitive process. And whenever you get a hyper-competitive process like that, whether it's VC investing, whether it's high-yield bonds, and you're talking about dropping covenants and so on, and it's a hot deal, like, people have to strike a balance, and it's up to those investors. You can always do more due diligence in every situation. I'm not sure they could have done less due diligence in this situation, but there's always some kind of balance there that you need to strike between winning the deal, getting the deal, and so on, and that's just part of investing. And so the fact that these VCs who are, that they've got great track records, famous names, et cetera, the fact that they messed up so badly, I think it's entirely on them. It's entirely fine. That's the way the capitalist system goes, and that's life, right? And if people don't like it, if you're an LP with those VCs, maybe you don't give them your next batch of money, and maybe you give your money to somebody else the next time around who promises that they're going to be more diligent.
Okay, unless the two of you want to talk about any prison experiences, Nick,
I'll
we'll
pass.
we'll give the final word to you, either on any or none of the.
Well, no,
topics asked.
I'll try and answer the question if I understand it. There were two things. I think fraud isn't always premeditated. Sometimes it happens out of mistake. So I think there's a combination of things there, and that goes back to the structures and controls being as strong as they possibly can be. If I don't understand the question properly, please question me afterwards, and I'll definitely try to answer it a little bit more fully for you. So I'm trying to work out the meaning of the word restorative, when I went to prison, I was locked up 23 hours a day in Singapore. It's a very tough regime. You sleep on the floor. Floor's very rough and uneven. Everybody's a triad gang member, so you're very alone. You have two other triad gang members in the cell with you, so you have to have a really long, hard look at yourself. And that was the process that I went through in prison. And I'm sure you'll see a lot of this with SBF over the next few weeks, months, or whatever. The first response is denial. So you deny everything. Everything's okay. We're going to survive this process or whatever else, because you can't deal with the failure. But over time, you have to start to come to terms with that. And for me, that was in prison. So there's nobody to talk to. So you've got, you can imagine, I've no idea. Most of the people in Singaporean prison, it's quite a young prison environment, because they still have capital punishment in Singapore. There's a lot of drug offences. Like I said, it's a very rough environment because everybody's a triad gang member. So you have to learn to communicate in a way without other people, because you don't really want to share what you're experiencing. So for me, I used to keep a diary. So they used to give me a book or a small exercise book, I suppose it would be. And every day I would write about things that had happened to me. Not necessarily just with the work environment, but the way that I'd been at home and other things that had happened to me during that period. And for me, that was a way of communicating and dealing with things that I was feeling. So you pull down that veneer, and you kind of end up with the conclusion that you didn't particularly like yourself or the way that you'd become. So you try to think of ways that you can improve that going forward. And I think the biggest part of that is being accountable, being responsible, accepting that you were punished correctly, and that you can then, from that point, you can move forward. And if that moving forward is talking at events like this, or I've done a few other jobs. I haven't worked in the world of banking since, but You know, I've had a few other jobs post that. Like I'm still, you know, for me, I'm still pretty much the same person that I was all of those years ago. You know, personality traits are still fairly similar. But you have to understand there's a good end and a bad end to the spectrum, and you try and position yourself a little bit closer to the middle. But I think going through that process, because it's something that unless you've been in that situation, you don't go through, it gives you the confidence, the self-confidence of who you are. So, you know, if you pick up a newspaper, I'd always be described as disgraced banker or rogue trader. I've been introduced at events where people have struggled for my name when they get close to the introduction. They call me that nasty person, Nick Leeson, which is fine. It's their prerogative, but they have to sit with me for dinner afterwards, so I make it very uncomfortable for them. A few weeks ago, I was described as former rogue trader, which for me was the you know, the ultimate comeback. I'm no longer a rogue trader. And then in Hong Kong a few years back, somebody described me as a market commentator, which was really polite but completely inaccurate. So you know, I don't know. It's yeah, you have to really, and SBF is going to go through this over the next few weeks, months, and whatever else. He's going to have a long, hard look at himself, come to terms with failing, and then work out where he goes from there.
Yeah, I think that coming to terms with yourself and working out where you're going to go in a vehicle of sort of responsibility and accountability, as you said, are very good words to end our very first day at Decipher. So thank you so much, you guys. I really appreciated having you on, and give yourselves a hand for getting through this whole day. We'll see you tonight and see you tomorrow.